Okay, so picture this. Have you ever been totally trapped by a market breakout that looked absolutely perfect, only for it to just suddenly and violently reverse on you? I mean, if you're a retail trader sitting in Lagos or Abuja, you probably know the exact pain of a bull trap. You see the price surge, you jump in, and literally minutes later, your position is deep, deep in the red. Well, in this explainer, we're diving into some fantastic source material that decodes exactly why this happens, and we'll look at why trading volume is the ultimate key to understanding what the market is actually doing.
So how do we know if a market breakout is actually real? To answer this, our sources use a brilliant analogy. Imagine walking into the popular Balagoon market in Lagos on a really busy Saturday. Hundreds of buyers and sellers are loudly negotiating, shops are just absolutely packed, right? Now imagine another market right next door, but there are only two people buying anything. Which market would you trust more to show you the true fair price of an item? The busy one, for sure, because more participants naturally create more reliable prices. And honestly, financial markets work the exact same way. An empty market versus a highly crowded one is your biggest clue about true demand.
You know, a lot of beginners focus entirely on the price chart. They see a price rising and just assume, hey, it's gonna keep going up. But our sources highlight a core axiom that you really need to remember. Price shows movement, volume shows commitment. Basically, while price tells us the direction the market is heading, volume tells us the strength, the actual conviction, and the real power behind that move. Let's dive right into Section 1, the language of the market. So what exactly is it? Well, trading volume is simply the total amount of an asset that gets bought and sold over a specific time. And a great way to think about it is treating price like a car and volume as the fuel. I mean, sure, a car might be able to roll down a hill for a little bit without gas, but it absolutely cannot travel far without fuel. It's the exact same with trading. Price movements will constantly struggle to keep going without strong volume participation. If you want a strong, sustained trend, you gotta have a full tank of gas. Moving right along to Section 2, price claims, volume proofs. Think of yourself as a detective in a courtroom, right? When you're looking at the evidence, the comparison is pretty stark. Let's look at scenario A. Price is going up and volume is going up. This is a super bullish signal. The trend is healthy, it makes sense, and it's heavily supported by the market. But then look at scenario B. Price goes up, but volume is actually dropping? Yeah, that is a massive warning sign. It means the market is running completely out of steam. Professional traders never, ever trust a price movement without checking this underlying volume confirmation first. Next up, Section 3, confirming real market trends. Think of a strong market trend kind of like a massive football stadium. To keep that undeniable momentum going, you absolutely require massive stadium-level participation. To make this actionable, our sources gave us a really effective trend confirmation checklist. Before you put your faith in a trend, ask yourself, is the price moving clearly? Is the volume actually increasing as the price moves? Are the buyers or the sellers firmly in control here? And is momentum strengthening? Look, if you have rising prices but the volume is just completely dropping off the map, that's what we call volume divergence. It's a huge, glaring warning that the trend is exhausted and a reversal is probably right around the corner. That brings us to Section 4, spotting fake market breakouts. Oh man, this is probably the biggest pain point for most new traders. You know the feeling, jumping into a breakout out of pure FOMO only to get instantly trapped. So what's actually happening behind the scenes of these traps? Well, large institutions sometimes create these bull and bear traps on purpose. They know beginners love to chase the price, so they push it just past a key level to trigger emotional trades and hit stop losses. That creates liquidity for their own massive positions. But here's your secret weapon against that. Low volume. Low volume is the ultimate detector of this trap. A fake breakout almost always lacks the high volume you'd need to actually sustain the move. So, how do you avoid getting trapped? Our sources outline a really strict 3-step process. First, just let the price break the level. Second, immediately check the volume. Is it significantly higher than average? Third, and honestly this is the most important one, wait for the candle to close. Seriously, never trade mid-candle. Wait for a successful retest instead of rushing in out of pure panic. Patience here is literally what protects your capital. Moving to Section 5, the Essential Volume Toolkit. Every detective needs a toolkit, right? But a quick heads up from our sources first. These indicators do not predict the future. They just help you interpret the evidence that's right in front of you. Now, there are hundreds of tools out there, but beginners really need to avoid analysis paralysis and just start simple.
Stick to volume bars for your general baseline analysis. Then you can use on-balance volume, or OBV, to help confirm the trend by showing if money is flowing in or flowing out. And finally, a volume moving average is great for instantly detecting unusual, spiky activity against your normal baseline.
Let's actually look at those volume bars visually. Typically, you'll see these sitting right underneath your main price chart. Taller bars mean high activity, shorter bars mean low activity. Pretty straightforward. But look at that third bar right there, that massive volume spike. That spike acts like a giant alarm bell. It's telling you something major is happening. It could be a huge news event, panic selling, or some massive institutional footprint just stepped into the market. Whenever you see that, you pay attention.
All right, Section 6, your volume trading strategy.
Taking all this theory and turning it into action takes a ton of discipline. Like our sources point out, trading without a strategy is basically like driving from Lagos to Abuja without a map, without a GPS, and without looking at a single road sign. To protect yourself, you really should follow this strict 5-step map. 1. Identify the overall trend. 2. Mark out your key support and resistance levels. 3. Watch that volume carefully as the price approaches those levels. 4. Wait for confirmation. Seriously, do not jump the gun here. And 5. Manage your risk. Just waiting for that confirmation and verifying the volume at key levels will radically reduce the chances of your trade failing. And hey, speaking of managing risk, this number on the screen is perhaps the absolute most important thing you'll take away from this entire explainer today. 1 to 2%. That is the absolute maximum amount of your capital you should ever risk on a single trade. No exceptions. Even the best volume setups fail sometimes, simply because the market is totally unpredictable. By using strict stop-loss orders and only ever risking 1 to 2%, you guarantee that you'll survive those inevitable bad setups so you can trade another day. Real quick, before we wrap up, let's fire off some of the most common beginner mistakes our sources highlight. First up, ignoring volume entirely, which, as we know now, is basically flying blind. Second, assuming high volume always means buy. Remember, heavy selling creates high volume too. Third, trying to trade every single spike instead of looking at the wider context. And finally, just purely FOMO trading against the trend without any confirmation. Avoiding these emotional revenge-style trading mistakes is literally the key to long-term market survival. And that brings us to our final thought for today. The market doesn't reward raw intelligence, it rewards discipline. Our sources make it perfectly clear. Volume is the ultimate lie detector for price. But just having the tool isn't enough, right? It's all about the mindset. Amateurs look at the market and only see potential profits, which just leads to a lot of emotional guessing. But professionals, they look at the market, they wait patiently for the hard evidence in the volume, and they ruthlessly manage their risk. So the only real question left for you as you look toward your next trade is, which one are you?